let's get rock and rolling here. All right, so the market has been in a rather narrow range, consolidating up at the top. And yesterday we had a Fed statement that was pretty much what I had said I thought it would be. I had written an article that was published in both Real Money and TheStreet.com, which are Kramer's websites actually, and I had discussed in it, originally the article had been, I had dubbed it Shadowboxing the Fed, but they wanted to search engine optimize it, and they called it like Apple is gaming the Fed to combat stagnant stock price. And I actually originally didn't really love the title, but when I think about it, it actually was rather quite fitting, because it is true, that is really what is going on. There is stagnant growth, and companies have been taking advantage of the cheap money policy, the ZIRP, and putting that money to stock buybacks and toward dividend increases or initiations of dividends, and really using the low interest rates properly, frankly. I mean, Apple has been able to reorganize its entire capital structure at interest rates that are lower than the government's. That's quite a statement. Unfortunately, as we heard in that Fed statement yesterday, that companies are doing this, and they are not investing in the future, so to speak, of their businesses or of the country. And we've had stall speed GDP, very weak durable goods orders outside of airlines. I'm just adjusting the picture here. And we've also had a pretty crappy unemployment situation. I know that the headline number is rather good, that they say it's like 5% and change, which is quote-unquote full employment. But it's really not when you look inside the numbers, so to speak. Sort of like how Market Profile looks inside the day's bars. The labor participation rate looks inside the unemployment rate, and it's been really low. It's actually the lowest in my lifetime in 36 years, since 1978. That's a really big problem for the Fed going forward, because their mission is for price stability, and also for to maximize unemployment, to hopefully bring it down as close to zero as possible. And they're not really going to be able to do that. I think that the problem is more structural than cyclical. I think that the Fed is aware of this. I mentioned in my article, I think we live in a golden age of Fed competence between Bernanke and Yellen, far superior to anything that we've seen in modern history. And Yellen is uniquely aware of this situation. Now, I took some notes from the Fed meeting, and these were some of the things that I thought were important. First of all, like I had said, the June hike is not happening. Very, very unlikely. The data is terrible. They are data dependent. If they are true to their data dependency on the stuff that I've discussed, the Fed should not be raising interest rates. They should be doing another round of QE. And we'll see if that takes place or not. I think there's a lot of political pressure for them not to, given you have now a Republican Congress. But keep in mind, Janet Yellen is a Democrat, and she probably wants Hillary Clinton or whoever the Democratic slate is to win election. So I don't know if they're going to get too crazy with their monetary policy in the next year. So anyway, June hike unlikely. They are, however, not going to give any explicit warning when they do decide to raise interest rates, meaning they're not going to kind of tip their hat, and they really want us to be data dependent as well. So they are not going to give us any warning. We'll just wake up to a Fed meeting. My suspicion is it'll be one with a press conference, and I'll discuss that in just a second. So the Fed won't give warning, but I think if they do the interest rate hike, they are going to walk it back and sugarcoat it to the point where it's like we're going to be scratching our heads like, did they raise interest rates, or what the heck just happened? So they say that they thought the Q1 weakness was transitory, although since this Fed statement was written, we have had new numbers since then, and the numbers have been terrible also. So their reason for the slowdown, which they cited, was weather, and the West Coast port slowdown may be true, but it's playing out to be past then. Now that the weather is improved as well, the numbers are still coming in kind of crappy. They expect the growth to resume. They always say this. They attribute that growth that's going to come thanks to the low interest rates, although as we know, they have started to rise, but they are still fairly historically low. They equate that to strong consumer confidence, which we know is now not so because we had a weak reading the last go round, and they say that we have rising incomes that are helping Americans. I don't know about you, but it seems to me like from what I said, the labor participation rate being low, I don't know where these rising incomes are going. They're certainly not going to people who have been unemployed so long that they no longer count in the employment numbers. So some of the Fed fears going forward, those were their hopes and dreams, so to speak. Their fear, it was interesting to me that they mentioned HFT, which is the high-frequency traders, and they were nervous about a Fed statement that comes out with an interest rate hike, tripping high-frequency traders and having some type of like crash in the market because of their raising interest rates. So I think what's interesting about that, and what I'm actually excited about, is that I believe that they're going to craft a statement when they actually do raise interest rates that are going to be mindful of this, and it's not going to trip the high-frequency traders, and we're going to have an opportunity to trade like a machine might and be able to trade on that information in real time without having the disadvantage of HFT having taken the market down 200 points, and now we're sort of like, all right, let's sell it in the hole. So we might have an opportunity to really cash in on that. One of the fears that they mentioned also was decreased broker-dealer inventories. And geez, they could thank that to Dodd-Frank. All the regulation that's happened has crippled the ability for broker-dealers to really be in the market because they're not really supposed to have prop desks in the sense that they used to, taking on systemic risk. So my thinking on that is that maybe there'll be some type of revision in this at some point, and this will maybe free up the banks a little bit. Although I'm not so sure that that's going to happen anytime immediately, like anytime soon. That's also been one of the reasons everyone's always bullish on the financials. If you really read some of the legislation that has taken place, these companies are like structured like utilities now, and they're never going to be able to have the earning capacity that they've had in years past. So please keep that in mind for people who are chasing the banks because they feel that a steepening yield curve is going to help make these banks profitable. Yes, it will. It'll help them make money. But they're not going to make the kind of money that they've made in the past. They also discussed a strong dollar and and oil, and potentially the price of oil rising as being a concern. Some of the growth that they had attributed in Premier Yellen's last statement was attributed to the decrease in oil prices. They have bounced significantly, and I actually think they're going significantly higher. I'm looking for $75 oil at some point. 54.25 is the must hold. If we start getting below there, I may start thinking we're having recession troubles, so let's keep that in mind. If the Fed doesn't continue easing, well, it's set off a violent move down. It may or may not. It depends on where the market is when they finally do the interest rate rise, and it also depends on how well the market is prepared for it. I'm not thinking that it's going to happen. I may be in the minority, but I don't necessarily know that it's going to happen this year. If they do it this year, I've heard the media talk about this one and done type of thing. And that doesn't really sit well with me because if the Fed has to reverse course and start raising or start easing again, it's going to look very bad and be damaging to their credibility. And I don't think that's really what the Fed is going to want to do. So I believe rates are going to be on hold for quite some time. I think they're going to want to string together a non-transitory better economy. And that is definitely not happening right now. I'm going to talk about interest rates in a second, and someone was in a interesting discussion I had on the stream today with regard to TLT. But they also discussed the slowing growth in China. We just had their flash PMIs last night, and they were weak. So we know that concern is materializing. And then they also cited, which I mentioned in the article, a Greek exit. There's something that the Fed didn't discuss, and it's something that I've been discussing, and that is the potential for the fall of Baghdad to ISIS. If that happens, I believe that will start getting the president's attention, and I do believe that will get the public's attention, and we may have another Iraq war. So that is something that looms large and I would be prepared for that type of a headline risk. I don't know that that will take down the market very significantly, but it will be good for, I think, at least possible 3 to 5% correction if that happens. So let's see what happens with that. Keep that in mind. I am being very mindful of that. There's also the possibility of some type of a natural disaster like the Japanese earthquake. That is not something any of us can game, but when that happens, it is real, and it's always a risk. So that said, the Fed is on hold. You know, they are dealing with a stall speed economy that is vulnerable to shocks, as I discussed. By the way, that article that I'm mentioning, if you haven't read it, I'm going to post it in the description. First of all, I'm going to tweet out the link when I'm done with the broadcast, and then I'm going to post the link in the description on the YouTube rebroadcast of this video. So if you're watching this on YouTube, or if you happen to want to watch it again, if you came in late, you can click on the link that's going to be in the description on YouTube, and you'll be able to read the article, and it's posted on the free site on thestreet.com. So now that we've discussed the Fed and my views on it, let me tell you a little bit about interest rates and why lower interest rates are good for stocks, and why people always seem to think when the bond market is rallying, it's bad for stocks. So that's a complete misnomer. The way stocks are valuated is done through what's known as a discounted cash flow model, which just means that interest rates are used to discount the price of stocks. And the lower that discount rate is, think about the divisor, the lower number. The lower that number is, the higher the product will be. The higher the lower number is, the lower the end product will be. Always remember that. Interest rates are very key. It was always taught to me in college, and this was common sense until recently, that lower interest rates equate to higher stock prices. For some reason, the media has decided that higher bond prices equate to dangers of a crashing stock market. Now, are they right or are they wrong? And my answer is I would say on the whole they are wrong. The caveat being that there is such low loan demand that interest rates are at crash level highs. And if you take a look at the TLT, I'm going to pull that up quickly now. The 2009 crash peak high was 123.15. And we've spent a lot of time above that. We're below it now, and we came into roughly around the start of the support that I see in the TLT. We didn't quite get the full measured move, which would have taken it down to 117.23, or the fib extension that I had been looking for. But I believe somewhere between 113 and 118 here is going to be the sort of the bottom in bonds for quite some time. I think we're going to see a healthy rally. I would have liked to have seen a little bit of extension with excess on the bottom to mount a more significant base to rally from. You know how I always talk about rallying from a secure launch point? We're rallying from an okay launch point. I would have liked to have seen a little bit more, the full measured move, markets like symmetry, and then we would have seen a pretty, I think, significant rally in the TLT. I've been looking for an entry point to kind of BTD, but it hasn't really set up in a way that where I felt it's solid enough. That being said, we may still see a rally higher in it, but I'm just a little bit cautious. I'd like to see it a little bit lower. I don't mean to agonize so much on this macro stuff. You know, I know you guys always like to know what's Apple going to do in the next 5 minutes, or is BABA, a buy or a short or what have you. But if you really nail this, if you really get the Fed and you understand it, you'll be able to understand moves and know when to be afraid and know when not to be afraid. And the media has done a very good job of trying to make people scared. And knowing some macro, I always like to blend technicals, fundamentals, and macro. And when I talk about macro, I usually tend to mean my outlook on the money supply and debt, like how easy it is for borrowing to take place. Hold on one sec. So I believe that if credit is fully available, I'm trying to get this ringing to stop, I'm sorry. I guess I'm a popular guy sometimes. No, not really. But I was getting a call. Anyway, so I lost my train of thought for a second. As you can see, this is a fully produced professional situation here, this Periscope. although I am trying to make it better and better. Macro. So the way I see the macro being important is the outlook on borrowing, the lending, credit flow. If markets don't really crash from old age, they die on recessions, and that usually happens when money gets tight. And that's also one of the reasons the Fed is mindful not to raise interest rates. They don't want money to be tight. They don't want a credit contraction. We just had one. We still sort of have one. There's like a global deleveraging that is still taking place, and I think the Fed is mindful of that. Higher interest rates would the policy overshoot that took place between 2004 and 2006, where Greenspan raised rates 17 times in a row, a quarter of a point, after telling everyone to take out mortgages, and unfortunately many of them were floating rate mortgages, and they they had interest payments that were really basically wound up crippling the economy. We know, if anything, that is far from the case here. We have I guess, historically normal interest rates. So what does that mean for the stock market? I believe that it means the market deserves to trade at a market multiple that is abnormal. It means that it should be higher than the historic norm as long as interest rates stay this low. And that's sort of been the game that the market has been playing, the game of chicken, musical chairs, so to speak, with the Fed. So we have no euphoria in the market. Everyone's always afraid, that we're at a top and a next crash. That's really kind of what you need. You need the public to be sucked in. Nobody talks to me about stocks. Not cab drivers, not my barber, not my dentist. No one outside of professionals or day traders who I speak with on the tape. So we know that the public isn't really in the market in the sense that they are during euphoria peak bubbles. We also know that the Fed is mindful of the possible weaknesses, and they want to keep I think they want to keep the system liquid, and they're sort of hoping over time that they'll kind of be able to inflate their way out of the situation that we're in. We had deflation, and that's truly the fear. So my thoughts on the Fed next action, I mean, the next action is going to be raising interest rates. It's just a matter of when. And I don't think that that's going to be for a while. I do believe, though, if there is some type of a shock and there is some type of reason, a catalyst, so to speak, we may see more QE, believe it or not. I know that's not consensus and it's not popular, although my statements usually tend not to be, and then they wind up becoming, which my article became. So it wouldn't shock me to see, believe it or not, some type of new easing. I don't know if they'll call it QE. They'll do something, though, if the economy stays as stagnant as it is. That is my opinion. We have social unrest. You saw what happened in Ferguson. You saw what happened in Baltimore. The Fed turns on the news. Janet Yellen watches TV. She's aware of this. How to play it? You play it as the trend is your friend. The market is still buy the dip until it shows otherwise. I will caution a few things with regard to the market. All right, so we did enough macro. We talked about the Fed. Let's get on to the S&P. So the way I see the S&P is we've been incrementally making higher highs and then having pullbacks. And the danger I see is that the S&P did something the last 3 days that I had been anticipating and saying that could potentially, actually, I know I said it wasn't before, but it may be a temporary market top that we're coming into. I had said that I thought that 213.40 to 214.17 is the 1.618 Fibonacci extension from the lows to now the highs. This is the full extension from the 2007 crash peak high to the 2009 March lows. This is the full 1.618 Fibonacci extension. So does that mean the market is over, that this is the top? It may be, but it might not be. What it is, though, is a point to be cautious and to be playing tactically. I've been discussing how I'm doing it. I've been saying that I've been playing with smaller position size on smaller time frames, looking for smaller swings. So if I was looking for 10 points in the past, now maybe I'm happy with 3. Or I'm raising stops or trimming and trailing quicker. I'm most comfortable buying stocks in a trending market. I'm also most comfortable shorting stocks in a trending market, meaning down. And the path of least resistance has not shown its hand yet. We've been in about an 8-month consolidation sideways, and only the last like in the last week, we've been breaking out of that consolidation and looking a little bit above. The last 2 days to me were a little bit more bearish, although they weren't really confirmed. They definitely weren't confirmed because you saw what happened today. I think the bears this morning had an opportunity to take the market down pretty hard, and they were short overnight. They all kind of knew we were going down, and we wound up not going down. And you had a bit of a I'm going to address both of those issues in a minute, and we had a bit of a reversal, a short covering rally. It was a bit of a P profile today. You know, B's are liquidation breaks and P's are short covering, and we haven't really had the excess in the market via a blow off top. Someone had asked that you'd expect to see in a market like this. I will mind you that in 2007 at the market top we didn't have excess with a blow off top. We had what was known as a complex top, which just means this same like now, a narrow trading range going back and forth for the better part of a year, and then eventually we all know what happened. The credit crisis struck and the bottom fell out. So I'm sort of mindful. I've been in the camp for a while that we do get a blow off top, that there is some type of major excess move to the upside, and that we do see that, but I'm not eliminating the fact that we could have some type of a summer correction, and one that could get a little bit more steep than usual if we have some type of news that is a catalyst. You could see the market is a little bit begrudging how it's such low conviction. The sellers have no conviction and the buyers have no conviction. I think that the sellers, the shorts, have been burnt so many times trying to leg into markets that they're sort of afraid to take anything longer than maybe a day or two. And the longs are a little bit nervous because they're getting these liquidation breaks and they're not really getting the moves higher that you'd expect. Like you buy a stock and it kind of goes a little higher and then it pulls back, and I keep saying that it's rallying. They keep rallying off of less secure lows. You're not getting these anchor lows of like retests to breakouts. It's rallying before then because people are so accustomed to playing by the dip. And like I said, the way to play this is the smaller size, the shorter time frame, and look for a smaller swing. I also suggest using stop loss orders. What do I think about the Greece direction? I think that the initial move on Greece will be a knee-jerk move down. I think that if that happens, I'm not 100% convinced that it will yet, but I do believe that it would be good for 2 to 3%, maybe even more in the market. It'll likely be an HFT-driven move initially. Whether or not it gets acceptance or not is another story. I think that the market is Greece isn't fresh. It's not a new issue like it was in 2011. Everyone knows about the euro, issue, and they're worried about contagion. And Draghi has been doing QE, which we did not have back then. So I don't know that a Greek exit will be as damaging as everyone thinks. The real question is the contagion. Will Italy and Spain and these other countries follow suit? And what's amazing to me is that these countries were like borderline bankrupt with like on the doors of like revolutions, and now they're borrowing at interest rates that are like amazingly cheap. To me, the real risk of Europe is being long their debt. How do you recognize HFT moves? Those are the easy ones to recognize. The short-term money and the high-frequency trading is the ones that move down in straight lines immediately. Like you'll see a 20-point drop in the market within 15 minutes or an hour. That's HFT. The real steady selling, which you would see from like institutional selling, isn't like that. Those are more of the trending days where you see them. They don't mind market profile. They don't know about points of control or value area highs and value area lows. When those levels support or resist, it's short-term money, day traders and short-term swing traders. The tactical money is involved. When those levels do not support and they are just you have steady selling throughout the entire day, that's when you're starting to see institutions unloading. And you'll know that because it won't just be one day. These firms aren't done. It's not like you or I trying to unload, 1,000 shares of Apple or, 100 shares of Google or whatever. These are people that need to unload tens of thousands, if not sometimes millions of shares, and they need to do it over the course of time. What institutions tend to do, and this is when you get market tops, is they mark up stocks to the point where their buying no longer can affect the share price, meaning that they can't buy anymore to make the stock go higher. They incrementally keep buying, and it doesn't drive the price higher. So what they start to do is they start to sell on rallies on the way down. And that's the only way, really the only way to do it. They rally it up to the highest point possible, and then they sell rallies on the way down. That's why people are always, I'm always a little bit more mindful. I like to buy stocks when they're in momentum upswings rather than trying to pick the bottom in a correction, because they might be unloading. The top in that stock may have happened, and you'll never see that price again. So I like to buy momentum stocks when they're on upswings rather than trying to pick the bottoms. So that's my theory on this. If you're concerned with regard to SPY, the levels that I see, and you might want to jot this down, that I see as key is it being over 212.48 for still higher prices, with room down to 211.27 on some type of a pullback being still healthy. If you get below there, that 207.84 is sort of the cautionary line. If we start getting below there, and the 100-day moving average has moved up to there, that has been key support. If we lose the 100-day, then I think that the 200-day could potentially be in play, and that might take us down lower. It's currently around 103.70. I don't know where it would be when we actually got there, but 206.42, 205.38, these are really key levels, and the most support being down at like 201.90, which is a gap fill and an old reference high. I think that would be sort of the limit at this point on a down move. If that starts to get violated and we get below there, then I think you're in a situation where the market is probably more of a sell the rips than buy the dips type of a situation. So that's what I'm really looking for. Those are the levels that I see as key. Let's talk about some of the momentum stocks. I know everyone is always curious about Apple, and I've been involved in an Apple trade. I had said that anything above, hold on one second, stop loss effective options on toss. Yes, stop loss orders do work. What I usually do with stop losses, though, with options, is I key off of the actual stock price as opposed to the option price, and like if it breaks my level, I'm sort of out of it. Unless I'm sort of short the premium and I'm looking to close it, I'll sometimes use IV or even stock. I mostly do it off the stock price. You can do it off of the option price as well, though. If you go into toss, there's a way of figuring out what the option price will be at a certain price. Do keep in mind, though, that there's theta decay and there's also IV ability to change, but you can tinker with that. I've done that as well. So anyway, with regard to Apple, 129.85 plus is good for still higher. Anything below there to me gets suspicious and suspect. I've been looking for a retest of the 133.60 and potentially the after hours high, which was 136.20. I've been doing it with a call spread risk reversal, which just means I'm short puts. I believe I did it with 36 DTE. I was short I still am. I'm short the 123s and long 129s and short 133s. I may tinker with that and adjust. I was thinking today about rolling up the 123s to 125s, but Apple Premium is so cheap at this point that I'm a buyer of the premium than a seller. Like, for example, I always talk about Apple taking a look at the implied volatility. Now, if you look at, let's say, the June monthly, it's currently 19.3% IV, which is really low. Apple IV the normal amount is 25 to 26, and anything below there to me is cheap premium, and if premium is too cheap to sell, it's you buy it. When Apple Premium gets expensive in the 30s or 40s, that's when I'm a seller of the premium. So I've been discussing this. that I'm more of a premium buyer, directional play premium buyer than seller here. And I'll stick to that story. I did the same thing in Gilead. That was how I play. I played that with some shares, and I also played it with call spreads and a risk reversal. So that's my thinking on Apple. Another trade I had been discussing on the stream, and quite prominently, is BABA. The stock, to me, it had gapped up to the channel high, and then it sold off with some weakness, and I had said that it needed to take 89.29 to be a long, and as soon as it crossed that level that it was a long, and we've all seen what's happened in the last 2 days. So the question is what now with BABA? Now, thank you so much. I'm more of a Reggie Jackson fan. I'm a Yankees fan, although I'll take the straw. Straw's cool in my book. Although the straw played for the Yankees too, so I guess that's okay. So anyhow, the IPO high of day, or the opening price, was 92.70. That was one of my targets. We eclipsed it and closed over it. The full gap fill for BABA is to 98.45. So I think somewhere between that low of day, that 97.79, and the 98.45, that area should be some resistance. You may see it get up to over 100. I believe that they need to manipulate this stock higher in order to unload the shares that are coming in September. I think they have like a ginormous amount of shares coming, and there's no way they're going to be able to do that down in the the 80s. It's too low. So I believe they have to kind of manipulate the price higher, and somehow that will happen. So short term, I think that BABA is going higher. If there's some type of disappointment, I think you can play by the dips, and just be mindful though, it needs to be over 89.29. And if you want to move the stop up, I think anything really below, what's this high here? Anything below 92 at this point starts getting a little suspect to me. I would be cautious on a move below 92. That was the move into the gap high of day. If we start getting below there, I'd be a little bit more cautious. I would be a little bit more suspect. You really shouldn't see that. Like if it does it tomorrow, I'd be very, very careful. So that's BABA. Are there any, I always say that I like to use Periscope more for the real Q&A on more qualitative things than quantitative, meaning the charts, because you can't see them. So it's tough for me to impart to you technical analysis with Periscope. I mean, I could mention levels, but I don't feel like it's as engaging, particularly since most of you are viewing this on a smartphone. So are there any questions that anyone has? Can you discuss the failed breakout in Apple and Home Depot? Someone was asking about Twitter. All right, so let's take that in reverse order. Let's do Twitter first. And if we're going to discuss Twitter, we'll discuss Facebook. So my view on Twitter is that there was a lot of kind of hot money involved in that stock. And I had discussed that I thought the stock needed to see back-to-back good quarters to get, institutional buyers involved, and that has not been the case. And I think this is sort of just going to be really choppy in a range for a while, and it's going to have to kind of change shareholder bases from the sort of chasers and the people who are holding out hope who bought it at 50 to people who now are sort of looking for more of a value type of a play, that they believe in the platform longer term. So the risk I see, I've discussed, is I see 36.07 and potentially 34.62. If the market gets really, really crazy and we get like some type of a really steep correction, I don't want to scare anybody, but the all-time low in Twitter is significantly lower. It was down at 29.51, and it is possible that there is a retest down there. I don't want to sugarcoat Twitter. I do think at some point, I believe you can start nibbling small Twitter here. I've done so myself, very small, a little bit. I do believe that at some point, I don't know how or when or what's going to get it there, and I have a sell order already put in, that it will get up to 45 at some point. Somewhere between 44 and 45.80. So let's say 44 and 46, and I just picked them right in between there. I do think at some point it's going to get back up there. I don't know how or what's going to do it, if it's news or if there's some type of a short covering rally or if there's some type of interest or maybe the stock just improves the fundamentals. I do think it gets back up there at some point. Facebook. So Facebook has been a really, really choppy stock that I believe is going to go to 100. I think that the issue with Facebook has been that there's been a lack of conviction and there's been some blow-ups in social media. The quarter from Facebook was fine. It just had a lot of people who had chased it, hot money again, and when something runs up into earnings, it's really hard to get it higher without really super-duper amazing news. And some of the reason Facebook was down was their exposure to the euro. That actually hurt them in their earnings. Since then, though, the euro has rallied, so that should weigh a little less on their earnings. But I believe that Facebook is investing a lot of money in their future, and I believe that at some point it's going to go to $100 a share, maybe even higher. I don't know what's going to get it there. I think it will be earnings, probably mobile payments, and some sort of... The thing I really like about Facebook, which LinkedIn and Twitter can't do, is that they can create new businesses with their user base overnight and have billion-dollar businesses in and to itself. They haven't even really started monetizing Instagram fully, and I think that that is going to be huge. They bought Instagram for like $1 billion, and at the time it was seen as being very expensive, and they actually, it's supposedly worth like 37 times more. I think it's been valued at like $37 billion. So that's a pretty big valuation jump, and I think Facebook, a lot of people think it's really expensive, and somebody on the stream had asked me a couple of weeks ago, do I ever think Facebook can eclipse the amount of money Google makes? And my initial instinct to answer that was that they probably can't, but I started looking at the numbers, and the reason why I think Facebook has been outperforming Google is because Facebook's growth rate is faster than Google's. Their revenue growth rate is accelerating as opposed to Google's, which has been sort of slowing down. So I think a lot of, and also they've been taking market share. You know, companies before were only really able, I mean, none of them go to Yahoo, right? So they all now go to either Google or Facebook, and, you know, Twitter is sort of trying to scrap around on the edges. I think the new thing that they're doing with Facebook, where they're putting the ads right in the news stream, they're going to have a new thing with news headlines that are built into Facebook, which is incredible to me because this is media basically conceding the war to Facebook, that now everything goes through Facebook, and they'll be able to sell ads at a better rate than the media. So I believe that Facebook is going to continue to monetize and make lots of money. That's my thesis. I think Facebook is the only investable social media site. You know, Yelp might have a takeover at some point. Twitter might, if it gets cheap enough. Maybe, you know, they get snapped up by Google or Microsoft. It's really hard to play for that because the problem with Twitter is their fundamentals aren't really improving. I believe that Periscope is good for them. I think that they're going to get it together at some point. I think that their management really needs to get their butts in gear, so to speak, and they need to start really getting serious about monetizing that property. Longer term, I think they'll do it. It's just a matter of when. Why Twitter cannot monetize like Facebook? Because Facebook is better than Twitter. Their management is better. Their platform is better. They have more users. They have a larger ability to, just the way the site is built. I mean, if you take a look at some of the website that Twitter has done, they've really tried to copy some of the Facebook design lately. And something that Facebook's been able to do really well, and they're going to clobber everyone when they put in their mobile payments. And Google just did this now with the Buy Now button. I think that's sort of the ghost of Christmas yet to come with Facebook, and that's going to be huge for them because people are placing ads on their site, and they're going to be able to just click the Buy It Now button and pay through Facebook with their mobile app. And they're also, I believe, doing like a MoneyGram type of thing through WhatsApp, and that I think will be huge overseas. And they'll just take a rake over that. Think of like Visa and MasterCard type of business. Speaking of which, Visa's been a little bit disappointing. That's a stock that I had been discussing, playing long. It's looked over the level it needed to and sort of fell back. I played it with a call spread. I put it on really cheap. It was like $1, and that would have been like my downside risk anyway in the stock. And it's sort of like almost, I look like a sort of a free option. $1, right? It's the price of a lottery ticket for something that has a much higher probability of going higher. The risk reward is I think 5 to 1, and I had been looking for a move to the upper part of the channel in like 73s or higher. So I think that Visa is either going to kind of get it together and consolidate and work here, or it's going to pull back into the 66s area, and that's a buy the dip at the gap fill. It's also a 61.8 Fibonacci retracement. I believe the exact number is 66.77. It's the gap fill is a little bit lower. There's a 50-day moving average, channel low there, 100 MA. There's a huge confluence of stuff. So if it gets back down there, I'll probably try it right out with shares down there, or maybe some type of a call, long call spread again. But it sort of just was a little bit of a tester for me. It wasn't a huge position just because I know we're sort of at the upper end of the range in the market, and my confidence is a little bit lower there since we've been in a responsive market. One of the things that also has me a little bit concerned is the VIX. It's really kind of toward the lower end of the range in the 12s right here. I mean, in 2007, it did touch 9 and change, and that was like the market top. It's possible we do that again, but the recent pivot low was 1182, so for me the risk reward with the VIX is setting up that there'll probably be some type of a spike in that, and it might have to do with a pullback in the market. It's also, when I find it hard to play stocks, like I'm finding hard entries or I'm having a hard time selling put premium, and that's usually sort of when you get that type of a spike and a pullback. Do you trade ETFs, or do you believe it's better to trade underlying stocks? I trade an ETF sometimes. I like the TLT, I like the SPY, IWM, the Qs, diamonds I think are okay. What I don't like are these highly levered ETFs that roll options, sort of like their future. They roll futures or notes. I don't like those because I think that there's an underlying current of decay. And also, these things have been beaten so badly that there are some people on the stream who play these quite regularly. They play it for like option decay. My fear of these is that they'll work until they don't, and when there's a spike in them, it's going to wipe you out because it'll be some type of a crash situation and they'll just like explode. So I'm not a big fan of those. I tend to not stay with them, but I do like the index ETFs, so to speak, or the utility ETF, or the IBB. I like the one for the biotechs as well. How do you learn to be patient in the market? It's tough. I'm still learning. I'm not, believe it or not, in real life, I'm not the most patient person. I particularly like fleet movements in stocks when they, give me what I want to see right away. The way to stay patient is just not to get too crazy in your size and just experience and realize that, look at your positions every day, and is the setup that you were looking for the same today as it was the day before? If it's still the same, stick with it. If it's not, if there's something that has shaken your underlying belief in the move, then, just GTFO. That's my opinion on it. So I think that I think we can wrap up. I think we're getting, we've been going for a while. I don't want to keep you guys too long. So thank you so much for watching. Be sure to follow me on Twitter. My handle is @JustinPulitzer. Be sure to follow my YouTube stream. It's Justin Pulitzer Trades. I'll put the link to that also. Actually, if you're going to see this on YouTube, just hit the subscribe button. That simple. I'll tweet out the link to the rebroadcast soon. Anyhow, thank you so much for tuning in. I appreciate it, and we have a long holiday weekend. Let's enjoy the weekend, the barbecuing, and I will see you guys on the stream tomorrow. Cheers.